Kia ora everyone, welcome back to our next edition of Econ Talks. Gareth, we are worried about a recession starting to come forward, a technical recession in the name really. But given we've been in this lockdown period throughout part of the third quarter, through that sort of September period, and then moving into those extended restrictions in Auckland and across the Waikato throughout the fourth quarter of the year, that December quarter, as well as the persistent restrictions around, we are in level two still, all I think signal this sort of worry about those recessionary pressures coming forward. I think we've got to remember, right, that we had a pretty good first half of the quarter in September. Spending was going berserk. We saw the pressures in the labour market. Wages starting to rise, still difficult to find jobs. We went into that level 4 lockdown for a few weeks. That was, again, a huge restriction on economic activity. But I think what we are going to see is that although economic activity might well be down, I think we're estimating perhaps around 7% from normal for that third quarter. Moving into this December quarter that we find ourselves in now, there is certainly that worry that we have economic activity perhaps down as much as 10% below normal, as we're in that part of the year where we usually would do a fair amount of spending. We've been looking forward to summer. We've now got more restrictions on. We're seeing that taking a toll on business activity over the longer term, and that is very much making us worried about a recession. I mean, from your point of view, outside of that technical recession though, what are things looking like for the New Zealand economy?
Yeah, I mean, there's a bit of uncertainty around some of those numbers. I mean, we know from last year's experience, estimating that 25% of the economy isn't operating at level 4 and about 12% at level 3. And that 12% at level 3 is still significant. It's a bit harder to judge some of those sort of level 2 numbers and how big they are in terms of restricted activity. But you're right. I mean, it does look like the December quarter at this stage will be softer than September. I think one of the most surprising numbers to be, or not surprising numbers to be coming through, but alarming numbers to be coming through is also where we're seeing consumer confidence. Most recent survey there from ANZ showed that confidence in October was down at its lowest level apart from in lockdown last year in April. So it fell away quite sharply, held up okay in August and September, but then falling away. And it wasn't just some of the broader questions about confidence. It was also households feeling about their own financial situation. And often we know with households that the here and now is quite important to them when they're making their spending decisions. A lot of them don't necessarily know where the economy is going to be in 12 or 12 months' time or even 5 years' time, as they are asked in the survey. But they know about their own budget and their own constraints that they're feeling at the moment. Of course, with prices rising, that is putting more of a squeeze on households' ability to spend as well. So some concerns there. On a more upbeat note, what we have seen on business confidence is that has held up pretty well. And surprisingly, given the ongoing restrictions in Auckland in particular, that the Auckland number shows through as being actually slightly stronger than the nationwide business confidence number from ANZ survey. So there's mixed signals there, but I think looking forward through into the Christmas period and beyond into 2022, I would be most concerned about that consumer confidence number if it is to continue to languish at low levels. And I think that's the difference between this lockdown and last time around. I mean, we had a lot of uncertainty last time around, but then the economy bounced back really, really quickly out of lockdown, and there was the sort of sugar rush, people making up for lost time in terms of their spending. But this is a little bit different, given one, that the lockdown has been more extended, and I think that sort of, particularly in Auckland, obviously brought a lot of people down and placed more businesses under stress, particularly in that sort of hospitality area. But there's also that uncertainty as we see COVID just starting to spread outside of Auckland, and getting the very clear message from the government that we are going to have to live with COVID. It is going to be coming around the rest of the country, and it'll be interesting to see how people react to that over the next 12 months or so, in terms of the way they spend and the decisions they make. How willing are they to go out and eat at a restaurant and cafe when there's risks around that, and potentially, exposing yourself to COVID. So yeah, quite a lot of uncertainty coming forward through 2022, and question marks just about how strong the bounce back might be. My view is it will still hold up pretty well, but there may just not be quite as rampant demand as we saw last year. And maybe that's a little bit of a blessing in disguise for some parts of the economy who've been struggling to keep up.
Absolutely, and I think you're right. We do sort of have those strong, solid economic fundamentals underpinning current activity and into the future, right? You've got unemployment now holding at 3.4%. You've got job ads still in a very strong position. You've got earnings that are continuing to go up. You've still got a bounce back in spending in the parts of the economy that are able to move around. And I think you're also right in terms of, look, it might well be slower, but that might also take a little bit of the excess pressure that we're seeing in the economy. But it does also mean that I think as we continue to go forward, it means that the bounce back in general from COVID-19 for New Zealand is likely to be slower. That recession, I think, putting people on their heels because of the supply chain and supply restrictions, right? It's not because people have no money. It's because they can't spend the money they have. That cash is still available to be spent out, but with rising interest rates and inflation continuing to go higher, on top of these sort of concerns around, well, maybe I don't want to go out quite as much. That's, I think, where you're going to have the drawback in spending activity. And I guess as we move ahead as well, the question is how well New Zealand starts to respond and react. Other parts of the world, their recoveries are continuing to move forward. You've got sort of that feeling that they are trying to get on with a new phase of life. But at the same time, we're seeing around the world case numbers still very high, hospitalizations and deaths still, in a pretty concerning regard. New Zealand, we haven't done that. We haven't done hospitalizations and deaths. We can still count in very small numbers what's happening in those areas. And because of it, I think it's going to mean that New Zealand wants to keep the pressure off our healthcare system and limit those hospitalisation and death figures for as long as possible to the degree possible. That does mean, though, that people are going to be less willing to go out and about and continue to spend like they previously did. And I think what that highlights as well, for businesses next year, the pressure is going to be on to continue the momentum that they're currently seeing. We know, for example, the likes of the health sector and construction have been two of the major growers of jobs over the last 12 months or so. Construction, there's probably surely at some point only so much more they can do. There's a lot of building activity to be brought forward. And again, the health sector, there's certainly more needed there, but again, there's got to come a time when things start to slow down after the rapid pace. And at that point, you sort of worry about where people might be starting to find jobs. There's still going to be a tight labour market, but that outlook, I think, for the next few years, possibly just a touch softer than we previously expected it as, again, we start to evolve through COVID. The final question, though, Gareth, I think I have for you is what are we thinking about when we look into the future, more than just a year's time, because we are still going to have to cope with COVID for a long time, with high levels of debt and similar with the potential for inflation to be holding higher for longer and spending possibly not quite as rosy. What else are we going to need to do to drive the economy forward out of that sort of slow lane into something with a little bit more acceleration?
Yeah, the questions start to turn away from growing the economy through just debt, like you say, and driving the labour market to a very unsustainably tight level, and turning to issues around productivity for the New Zealand economy. I mean, guys, that's been a 30-year issue, if not longer, really, that we've really struggled to do something great in that space. But yeah, it is that sort of weight of debt hanging over us, particularly from a government sector point of view, because that is going to also be a big shift eventually when we get past needing to support the economy and provide that immediate support for businesses who can't trade and make sure that people keep their jobs. The government is going to be facing not a debt position that is anywhere near as critical as many other countries, but nevertheless, it's certainly the debt levels have risen substantially within New Zealand as well. And so that growth in government spending, whether it's capital spending or operational spending, that will be slower over the medium term also. So I think it's a case of realising that yes, we've achieved some very good economic outcomes and some good growth outcomes over the last 18 months or so, but that has been by almost fiddling the numbers a little bit by bringing forward activity from future years. And so I think it is coming to a realisation as those interest rates rise, as those sort of government spending levels or rates start to ease back, there is going to be that much more difficult to achieve a growth over maybe a 5, maybe even longer, a 5-year or 10-year horizon.
Absolutely, and I think you make a very good point. We are dragging spending, investment, everything from the future into the here and now to prop things up, and that is certainly a better position to be in and a smarter move than to let the economy fall down now and take longer to rebuild that momentum. but it means that we have more limited choices in the future. We've got to be working a lot smarter rather than a lot harder in future to eke out the gains that we've been expecting to bring forward. So, you know, in a sense, we talk about, is this a sprint or a marathon? Well, it is a marathon, and we've sort of only passed, you know, the first K mark, and we already feel a little bit exhausted. We're going to have to figure out where the next water stop is, in a sense, and figure out how to do that in a different way. We will, I guess, continue to assess not only what happens with economic activity in the short term, but where government investment and spending might go in the future, and what that means not only for short-term growth, but New Zealand's long-term aspirations. And we'll keep everyone informed about that and everything else on one of our future editions of Econ Talks.